Will selling stock with large capital gains affect your taxes by pushing you into a higher tax bracket? I'm Ken from Hoyt Wealth Management, and I'm here to explain the difference between ordinary income taxes and long-term capital gains taxes and provide a few examples. Capital gains occur when you sell something for more than you bought it for. Even though these gains are included in your total taxable income number, they are actually taxed at a much lower rate than ordinary income taxes, provided that you held the investment for more than 1 year. Regular income taxes have 7 different tax brackets, ranging from 10% all the way up to 37%. Long-term capital gains taxes only have 3 tax brackets. The first one is actually 0. The second one is 15%, and the third one is 20%. Let's look at a few examples, which assume joint filers taking the standard deduction and all capital gains are long-term. Let's say a couple has $206,700 of wage income and no capital gains. Their tax liability will be $29,156. Part of that will be at 22%, some of it at 12, some of it at 10. Now let's say that same couple has a $100,000 long-term capital gain event. At first glance, it looks like they are now pushed into the 24% tax bracket because their total income is $300,000. However, it does not push them there. Their regular tax liability is still $29,156. They also will have a capital gains tax of $15,000, 15% of the $100,000. Let's look at this the other way around. Let's say a couple has no wage income and therefore no regular income taxes, but they have $100,000 in long-term capital gains. Their tax liability is 0, believe it or not. The standard deduction lowers their $100,000 to less than $96,000, which is the top of the 0% tax bracket. So they have no income taxes and no capital gains taxes. This is actually a tax planning strategy called tax gain harvesting. Now let's add the wage income back in. So the $100,000 capital gain is still there, and now we have $206,700 of wage income. Do you see what happened? We're back to the second example. Their regular income taxes is $29,156. However, their capital gains are no longer taxed at 0. Their capital gains tax is going to be $15,000 or 15%. Here's the bottom line. Long-term capital gains will never push you into a higher ordinary income tax bracket. However, wage income can push you into a higher capital gains tax bracket. This happens because the wage income ends up filling up the 0% capital gains tax bracket. Thank you for watching, and I hope this makes sense. If you have any questions or experiences you'd like to share, please do so below. And don't forget to tune in next time, where I'll be discussing alternative minimum tax, or AMT. Thank you.